Hi, my Bitcoin followers! We're in a gold rush right now by Michael Saylor. Bitcoin price is in a precarious position, on the ropes after a nasty sell-off, and on the cusp of losing support. While all this is happening, MicroStrategy CEO Michael Saylor continues to buy BTC, adding to the corporation's already sizable position. And now, Michael Saylor says we're in a gold rush right now. So, in today's video, we're going to see what Michael Saylor has to say about Bitcoin Gold Rush. Without further ado, let's begin. For more interesting content, make sure you enable all notifications to our channel, give this video a thumbs up, and don't forget to subscribe. And stay tuned for the hottest secrets and information of Bitcoin. The Bitcoin frenzy seems to have reached new heights lately, spurred by a growing user base, price volatility, and the rapidly evolving network of Bitcoin-related companies. Reports of big investments in mining equipment and the expanding ecosystem supporting the protocol remind us in many ways of a gold rush, an analogy made easier by Bitcoin's other similarities to the precious metal. It's hard to say whether this excitement is warranted, but it's equally hard to deny Bitcoin's increasing relevance to businesses and the broader economy. Bitcoin, along with other cryptocurrencies, may have implications not only for the technology industry, where much of the current action is concentrated, but also other industries from retail businesses to financial services. While there are plenty of market participants that cheer the corporate crypto bull on each time it happens, the more the company holds, the more systemic risk it brings to the first ever cryptocurrency and its underlying network. Popular opinion is everything these days. If you don't wake, well, you might as well not exist anymore. The hive mind tends to think all alike, and going against the crowd leads to being an outcast. At the expense of going against popular opinion and the risk that comes with it, there's a need to call attention to the risk that's being created in the top cryptocurrency by market cap, thanks to one specific actor, Michael Saylor. With an international focus on sustainability sharpening, the energy consumption of the world's first ever popular virtual currency, Bitcoin, is being put under the microscope. Its most vehement detractors argue Bitcoin uses an unjustifiable amount of energy and represents a thorn in the side of the wider green transition. Bitcoin advocates, on the other hand, claim this is an oversimplification and measures can be taken to ensure the blockchain network becomes sustainable long-term. Due to climate concerns, Elon Musk announced that Tesla will no longer accept Bitcoin. But how much energy does Bitcoin actually use? And can anything be done to ensure cryptocurrencies at large scale sustainably? There is a narrative among the Bitcoin faithful that what they have bought offers not only investment potential, but freedom from the powers that dominate government-issued fiat money. Cryptocurrencies are described by their fans as a people-powered revolution, digital banking unchained from the interests of the wealthy and powerful. Michael Saylor says this may well have been the original intention, but the modern reality is that almost all Bitcoin investors own less than 1% of one Bitcoin. These retail investors make up more than 75% of addresses, but own a tiny fraction, 0.22%, of the market. The top 100 Bitcoin accounts own more of the cryptocurrency than the bottom 38 million. In the crypto economy, businesses and wealthy individuals control currencies more actively than any central bank. They do so not to maintain the market, but to further their own interests. And he said, through successive booms and busts, the price of Bitcoin has been manipulated by a handful of large players, using fake transactions, imaginary assets, and sophisticated timing. In doing so, they create real demand, as celebrities and financial institutions respond to the attention and encourage millions of people to gamble money on a product they barely understood, in the hope that it would make them rich. The entire point of Bitcoin was so that no third party or one actor could influence the network of money itself. Even Satoshi Nakamoto disappeared from existence for this very reason. The emergence of figureheads in crypto is rather new, with the likes of Elon Musk coming out of nowhere and then suddenly commanding the masses of crypto holders. They listened. Dogecoin went to the moon, as the spaceman said, and it's since come crashing back down to reality now that the billionaire isn't coming to buy their increasingly heavy bags. A decade ago, names such as Bitcoin, Dash, Ethereum, and Monero were merely buzzwords. Fast forward to today, and they've become as recognizable as the US dollar and the euro. In many realms, these digital currencies are ushering in a new era of investing, a modern gold rush, albeit a digital form. As was the case during the physical gold rush in the mid-1800s, there are criminals looking to exploit innocent parties for their earnings. Carbon Black has found that modern-day cybercriminals are increasingly using the dark web to facilitate cryptocurrency theft on a large scale. During the past 6 months, VMware Carbon Black looked into the dark web to determine how cryptocurrency malware is being bought and sold, fostering a burgeoning economy designed to pilfer some of the most popular cryptocurrencies on the market. In an interview, he said, "We're in a gold rush right now, or a Bitcoin rush. Between now and 2035, we'll have mined 99% of Bitcoin. So, you've got 14 years, and during the 14 years, the block rewards are pretty high relatively. And it's very lucrative to be in the business, but the business is going to be less profitable. At the very least, we know it's going to rotate into a transaction fee business. So instead of a 90% block reward and 10% transaction fee, you could experience a 90% transaction fee and a 10% block reward. And the transaction fees are also going to scale more likely with the log of the price not linear to the price. If you want to move $1 million, I might pay you $10, and if you want to move $10, I would pay $12. But I'm not going to pay $100. I'm just going to overbid the $1 million buyer. And if I want to move $50 million, I'll bid $14. So the transaction fees will increase with the number of transactions on the base layer, and that'll be a dynamic, but the block rewards go away, and if you're a Bitcoin miner, it's a very lucrative high-growth business right now. But it will move towards an efficient transaction security network later, and you would do well to buy Bitcoin. Right, that's why it makes sense to hodl Bitcoin if you're a Bitcoin miner. My other point here is yes, it's true. Bitcoin miners should keep Bitcoin, but it's also true that non-Bitcoin miners should keep Bitcoin. If you have the operating income, you should invest in Bitcoin. If you are able to generate financing and you can raise debt or equity, then you should also raise debt and invest that in Bitcoin. So that would be the case for other companies like MicroStrategy looks at it that way. We're not even a Bitcoin miner, he said. So that's my thought on the Bitcoin mining network and the dynamic model over time. I think that some people intentionally misunderstood this. Like people that like proof of stakes. They intentionally misunderstood it because if they misunderstand it, then they can assume the energy consumption is linear, and then they can play the ESG card and pretend due to their virtue signaling and say they're doing something good for the environment because they're not using energy. But the truth is, they're not using energy nor are they using technology. For more interesting content, make sure you enable all notifications to our channel, give this video a thumbs up, and don't forget to subscribe. And stay tuned for the hottest secrets and information of Bitcoin.